I'm coming at this from a bullish perspective. We got plenty of silver left in the ground. It's just what cost is it going to be to take it out of the ground? And you have to understand that with these low prices for such a long time, I wouldn't be surprised if we do run into a kind of an acute supply crisis in the future.
Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So, what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and back with us today is Matt from the Silver Fortune YouTube channel. Matt, thank you so much for joining us today.
Hey Elijah, thanks for having me on again today.
Definitely. I was looking at it, and yeah, I mean, it seems like you're doing a really great job on YouTube. You're getting, thousands of views per video. Can you tell us a bit about what's happening right now?
Yeah, YouTube started out as kind of a hobby for me a little over 2 years ago. And since then, it's certainly still a hobby, but it's become more of a passion of mine, something I do on a daily basis because, precious metals, the markets, the economy, I just see this as all so important. There's a reason that I don't delve too much into things like, politics or whatnot on my channel, not because I don't think those are important, but because I love talking about the economy, about precious metals and all those topics, because so many people just fail to understand how important they are to our life. I mean, how many people really care about the economy right now? Usually the case is that people start caring about these types of topics when the stock market is crashing, or when they're losing their job, or when precious metals have already move through, half of their big rally up. That's when people start caring. I'd prefer to get ahead of these things and start talking about them now and document them now. And I think, as you can see, a lot of other people are kind of the same mind, because I've been, in the last year or so, receiving quite a bit of a response from my viewers.
Yeah, definitely. And yeah, it's always good to stay up to date on all these topics. And one of the topics you recently reported on was about this new deposit found in China of silver. What is your perspective on this? How does it impact the silver market? Is this bearish because now there's more silver than we thought? What's your perspective?
Yeah, so when you look at it, the mining sector as a whole, this is not just China. This is U.S., Mexico, Peru, wherever you're hearing about these reports of new deposits. Just saying that there's a such and such deposit doesn't give us a ton of information. So, the ballpark figure that they gave us was about 1,500 tons on this one. And this is in the Henan province of China. This would be in addition to what the article I was referring to in that video quoted is also a 2,611 ton deposit, also in that same area, discovered relatively recently. Now we have to kind of be careful with those types of ballpark figures. There very well could be 15, there could be 2,000, it could be 5,000 tons of silver in the ground here. It's just, what's the ore grade? What's going to be the cost? Is there an economic reason to extract those metals, especially at the current price point in the $14 range for silver. Now, 1,500 tons, if you convert that to troy ounces, that comes out to a little over 48 million troy ounces, roughly 5% of 1 year's supply. And this is something that will probably take several years, several decades possibly, to be kind of exhausted. And so in the whole scheme of things, this deposit finding, or other relatively large ones that were found in China, and that's, who knows how large these are, because the mining sector, as I said, worldwide, sometimes is not always maybe the best at giving us figures that are actually accurate. But, if you look at this on the broader scale, it's not extremely bearish for metals by any means, especially in the short term. These mines, just because they found a deposit, these might not be tapped into for another 3 years, 5 years, 10 years. It takes a long time to get the infrastructure in place to begin a mine of any nature. And also there's the question is China willing to, because they do have much more centrally driven economy and less I guess, freedom through individual corporations. Are they going to pursue this mining project right now at $14 an ounce? I mean, why would they? Why wouldn't they wait until it's much higher? Now, so in the whole scheme of things, I don't see this as extremely bearish for silver. But a point that I made in that video is that this does kind of fly in the face of, I think, what some people have said is a very stark outlook for how much silver there's left in the ground. And I'm not going to name names, but there are individuals here on YouTube or elsewhere on the internet that look at very static data. A good example would be past reports from the U.S. Geological Survey that say we have X amount of years left of silver supply in the ground, that the metal is endangered, soon to be in the extinct list. And the reason I say that is static is because it doesn't take into account new discoveries. It doesn't take into account this discovery in China, the recent one that I just referred to, another one earlier this year near Mongolia, inside of China's borders, that was also very large. And that's just scratching the surface. That's just China. They're not even the largest silver producer in the world. You can talk about recently or other deposits that have been discovered in Mexico or Peru or Poland or wherever we're talking about. That haven't been tapped into yet. There's a lot of, I think, silver supply left in the ground, and yet I still say that, I'm saying that, no, we're not going to run out of silver anytime soon from a very bullish perspective on silver. I think you can be a bull on silver, a bull on gold, and still say that, hey, there's still a fair amount in the ground. And so that was kind of the point of that video. And the reason I say I'm still a bull is for two reasons. A, you have to ask yourself, what is the cost to extract those metals? And that's, again, more information that we couldn't reasonably expect that information from any mining company at this point in the operation, in reference to this report from China. But what is the cost to extract it? And so, as much as I am saying that, yeah, we're running out of silver, ore grades are still falling. The cost to produce gold is still going up as these ore grades fall. The deposits they're finding are less and less rich, or they're continuing to mine past deposits that are just not what they used to be. The other piece of it is that when you have low prices in a commodity sector, whether we're talking about oil or precious metals, when you have low prices for a long time, the effect that has on the supply going forward it's a big deal. Basically, what I'm saying here is with silver being in the $14 range, if you recall, it bottomed below $14 back in I think December of 2015, January 2016. That time period, it was kind of around where it had been earlier in the fall of 2018. Since then, it has stayed relatively low. It moved up over 20 in 2016 with the Brexit vote and the upcoming election. Other than that, it's been below $20, and for the past couple of months, below $15. And so, with that low price action for such a long period of time, that disincentivizes mining outfits to invest in new production, invest in even exploring for new mines. And so, again, I'm coming at this from a bullish perspective. We got plenty of silver left in the ground. It's just, what cost is it going to be to take it out of the ground? And you have to understand that with these low prices for such a long time, I wouldn't be surprised if we do run into a kind of an acute supply crisis in the future, just because they simply haven't invested, especially primary silver miners.
And it's interesting. I mean, if silver is too cheap to mine out of the ground, I mean, that can only push the price higher eventually, right?
Yeah, eventually, the other, as I said, this is a very complex topic. We can't approach this from just from just a static approach. This is dynamic. New deposits are always being exhausted and found. But there's also the fact that precious metals, silver in particular, is mined primarily as a byproduct, meaning 70+% of mining supply that comes onto the market each year is mined from a mine that would not consider itself primarily a silver mine. Primarily, they are zinc, lead, copper, and gold mines. And so that's another thing that's important to understand too, that you have the primary silver miners, and they would kind of fit into the box that I was just talking about, just maybe not having the capital to invest at these low prices. But when it comes to these other, base metals, we'll ignore gold for now. that incentive absolutely, is going to continue to exist for a long time. And so they could be looking for any number of, copper, lead or zinc deposits, and silver just happens to be found alongside those metals oftentimes. Now, the other, way that I kind of approach this from a bullish aspect is that we know that silver has a fair amount of industrial demand. And so some people will say that in the next economic downturn, let's say we see a major recession, major depression, they use that as kind of a reason for silver to go down in price because people are going to be buying fewer cars, fewer TVs, building fewer houses or apartment complexes or whatever. And so there's going to be less industrial demand for silver. But what we have to understand is that, roughly, I don't know what the recent numbers are, 60, maybe 60+% of demand for silver is industrial. When it comes to a metal like copper or lead or zinc, we're talking basically 100%. With the exception of maybe what you could technically call like monetary demand for like zinc or copper that's in some coinage around the world. Otherwise, we're talking mostly industrial uses. And so they're going to be experiencing even more. And so I mean, let's say the economy declines by 5% in a year. You're going to see significant cuts in zinc, lead, and copper production at many of these mines. I'm not detailed. Maybe some of them could go out of business, maybe not, but they're going to have to cut production because demand is just not going to be there. And so, when you have silver being mined as a byproduct at these mines, then you're going to see, that supply come off the market as well. Who knows? Depending on how high silver goes, you could see some of these mines continue to be open just because silver it'd be worth mining. It'd become a primary silver mine because of how much silver could be worth, and maybe some of these copper and zinc, they could become the byproduct at some of these mines. That's just, who knows? It all depends on what the price would be. But that's another thing to understand, that an economic downturn is not necessarily the end game for silver, because you'd have the supply being taken off the market at the same time.
Now, moving on here, like with respect to your exit strategy for silver, I know you created a video on this, and you were saying that, it doesn't look like anytime soon is the time to move out of silver, even if it goes lower. But there would be a scenario, possibly if stocks crash, which some people are predicting the stock market to continue down from here, that if the stock market did fall far enough, it might be a good idea to exchange some silver and purchase some stocks. But what is your perspective on this? And just, obviously you can't give financial advice, but just what are your 2 cents on this issue about your silver exit strategy?
Yeah, certainly. My overall strategy right now, when it comes to buying, there's not a price point where silver drops to X price, $10 an ounce, $8, $1 an ounce. It's ridiculous. But let's say it did, I wouldn't stop buying, and I certainly would not sell my silver at that price, unless, at $1, I almost for sure could say I wouldn't. But there's no plans in my future to sell my silver, certainly below $20, below $30, unless I need those funds for something else, because for me, it is a bit of a savings account as well. If nothing else, I'll be buying on the way down, buying on the way up, at least at $20 at my current pace. And beyond that, depending on what's going on in the silver market and other markets, buying beyond that as well. Now in that video, the price point that I laid out as kind of the threshold where I start to consider exchanging precious metals, be $30, which I understand, some viewers are going to be like, that's nothing. I mean, we hear these price predictions of 50, of 100, 500 all the time. And I get that. But the real takeaway from my own personal exit strategy for precious metals is not necessarily just the price point in dollar terms or otherwise. It's what's going on in the other markets. So I could provide you an example. Silver could go to $50, and I might feel very comfortable exchanging some of that for the stock for stocks, good solid stocks. We could see a scenario where the economy does very poorly. The Dow, the S&P, they drop by 50%, 70%, whatever. And in that situation, and if silver was at $50 an ounce, I would feel comfortable doing that, unless, we're having some massive amount of inflation, then I'm not so sure about that. But then there's also a situation where silver could be at $100, And I might not feel comfortable selling at that point because maybe the stock market is continuing to roar higher on the back of inflation. I mean, an extreme example, but look at Venezuela. I mean, Venezuela's stock market has been one of the best performing stock markets in its own currency for the last couple of years. But obviously that's not the case when you look at the value of their currency versus other currencies. And so, it really depends on what's going on in other markets, what's going on in other assets that I would consider. The big ones on my list that I would consider selling silver for. First of all, in a worst case scenario, normal expenses, whether that's bills, whether that's fuel, whether that's food. Okay, the worst case scenario, the proverbial SHTF scenario that people are always referring to. Otherwise, stocks. I'm not totally averse to stocks. Certainly, they seem very inflated right now, very high right now, and I don't think that they're good price. Again, my own take on it, but they would be, fall into that category. Things I'd consider, things like real estate, things like land, that could go on the list as well. But then things like fiat, just cash from whatever country, or even bonds. Those are the types of assets that I think are going to really bear the brunt of this, shift away from just paper, shift away from digital assets, because we're seeing such a big shift into those assets. People are treating them like they are. I mean, they treat bonds as not quite a cash equivalent, but as a safe haven asset. I just don't think that's the case. You take, for example, like the U.S. government treasury debt. Do I think that the U.S. government is going to default on their debt anytime soon? No, I don't. I don't think that's in their strategy. I tend to think that they're eventually they're going to go the way of massive inflation rather than defaulting on their debt. And so what that means is that, if you buy a 10-year bond right now, or some equivalent of that, buying to some bond index, then they very well could pay you out that yield over the once it eventually matures. You could exchange that for US dollars. But what's happened in the meantime in terms of inflation? Who cares if you bought a 3% yielding bond if over the next 10 years we average 5% inflation, 10%, 20%, And so, things like bonds, government bonds, I don't see as a sure thing. And corporate bonds, depends on the corporation, but certainly I see that as risky as well. But, really it comes down to stocks and real estate as kind of being high up on my list. And as for converting it, this is not a all at once type of thing. I certainly don't ever intend to get rid of all my precious metals, no matter what the price is. But some of them, sure. And I don't think, let's say I want to get rid of 50 or 70 or 20% of them, whatever it is. I wouldn't do it all at once either. 5% here, 10% here, slowly do it over time. No different than saying that, hey, I'm going to buy these precious metals over a long period of time, dollar cost average, rather than buy them all at once. So that's kind of my own take on my own exit strategy. I got some criticism, people basically saying, why would you ever consider selling your silver? This is something I plan on holding on to forever. Obviously, I'm a huge fan of silver. Not just because I think it's going to be a good investment, but because I think silver and gold have some unique traits. Things like no counterparty risk, the fact that they're so compact, the fact that they'll always have industrial uses. They are unique. There's no other asset on the planet that acts like a precious metal. Okay, so for that reason alone, they're great to own. But I'm not married to my metals. I'm not married to it as an investment. And I understand that if the opportunity presents itself, if we're in the right climate, exchanging for a different asset absolutely could help to increase my own wealth, and who knows, in the future maybe that means exchange some of that back for precious metals once they move down to maybe a more reasonable level. I do think that precious metals, especially silver, there's going to be a speculative phase in the future, right? Right now we're in the blood on the streets phase, but eventually there's going to be a speculative nature to silver where I think it will actually go too high. It'll become overvalued. Maybe the gold to silver ratio will go too low, And so, would you want to hold on to it in that situation? Probably not, unless, we're dealing with massive inflation or a massive, economic collapse in that, happening at the same time.
Now, mentioning this economic collapse, you've been talking about this for a while, and you're thinking that there is an economic downturn coming. We talked about this last time we had you on. Did you want to share with the viewers maybe some updates on this? Maybe you recently put out a video showing some more signals that confidence in the economy is collapsing. So, yeah, I mean, can you give us an update on your perspective on where the economy is now?
Yeah, well, the story for a long time has been debt. An indebted world, a world that is saturated in debt, and you can see this all around. And it's no surprise that we are saturated in debt. I mean, that's what you get with easy money. That's what you get with rock bottom interest rates. I mean, this is something people have said in the past. I've said in the past, but you have to understand that interest rates around the world over the last 10 years, whether we're talking about federal fund rates from the Federal Reserve or the ECB, their base interest rate, Bank of Japan, we're not talking just low interest rates. We're talking the lowest interest rates have been in probably recorded history, for a very long time in the Western world, in a developed economy. So you have to understand that with low interest rates, absolutely, that's going to stimulate debt. And debt has been the name of the game in growing our economy. And so people are always talking about, including myself, documenting, well, the U.S. national debt is at 15, it's at 18, it's at 20 trillion, now at 21, getting close to 22 trillion. The consumer debt is at very high levels. Corporate debt, which oftentimes people forget, is at very high levels. But the thing about debt is that it matters, but it doesn't really begin to matter until servicing that debt becomes unrealistic, becomes very expensive. And what is it that ultimately causes that to happen? It's rising rates. And that's kind of what we've been experiencing right now in the U.S. economy. Certainly not around the world yet. Bank of Japan, ECB, still ultra low interest rates. But here in the United States, the Federal Reserve has been raising their Fed funds rate. And that's why stocks are kind of looking so shaky right now over the last couple months, because the question is, how high are they going to raise rates? Now, I don't know how much higher they have to raise them for this downturn to still occur. Many people are talking about this next Fed meeting, which is occurring next week, and will they raise interest rates or not? And if they do, what is 2019 going to look like? Unless we see a major downturn between now and then in the stock market or some other major data come out, I think they will probably raise rates one more time in December. But heading into 2019, I think they're going to pause, potentially for good. Depending on what happens in the stock market and the economy, and certainly inflation numbers, they could be pausing for good in 2019. But something that I think is really important to understand is that we should not underestimate the other piece of their tightening plan right now, and that's quantitative tightening. So what I'm saying here is that the Fed could raise rates in December, not raise rates until midway 2019 or never again, in this cycle. But they're going to continue tightening in the meantime through their quantitative tightening program. So this is basically, a quick review. This is reverse of quantitative easing. Instead of buying bonds and mortgage-backed securities, they're allowing them to run off their balance sheet. And this is a big deal that people are underpricing the effect that this will have on the market. Equities could rally if the Fed comes out and hikes next week, and it's just a dovish hike, and they say, we're going to hold off. It's going to be a wait-and-see approach. But the markets will ignore the fact that the Fed is going to continue tightening regardless of if they raise interest rates through quantitative tightening. To put this in perspective, earlier this year, I'm sure you remember this as well, Elijah, there was this big news article that came out about Russia decreasing their holding of U.S. Treasury debt. Okay, so this was, I think this was through July. They reduced it from roughly $96.1 billion in bonds to $14.9 billion. So that's a change of $81.2 billion in Treasury debt. And you saw rates rise you saw yields go up during that period of time, meaning the price went down. And so maybe they did have some significant effect on the market. Now, in the whole scheme of things, Russia is a much smaller holder, even back then, compared to China or Japan, two of our biggest holders of U.S. debt, foreign holders. But to put that in perspective, it was a bit of a market mover, that $81.2 billion dollars of selling. And yet that's not even a full quarter's worth of quantitative tightening. I mean, meaning that in 3 months, the Fed unwinds about $90 billion dollars worth of bonds from their balance sheet. And so that's tightening. And not only are they reducing liquidity, not only are they essentially destroying money, they're also removing some of their influence on the bond market. And that's not even also to speak to the $20 billion a month of mortgage-backed securities that they allow to run off their balance sheet. Right. And so they're not selling these. They're just letting them mature and not reinvest those funds. And so, I mean, there's still a buyer of bonds, still a buyer of mortgage-backed securities based on whatever they have left on their balance sheet. But their influence on the market is less, meaning that the $150 billion over the next 3 months that they let unwind on their balance sheet, that's $150 billion that the rest of the market is going to have to pick up somewhere else, some buyer for both bonds and mortgage-backed securities. The next 6 months, we're talking $300 billion. The next year, we're talking $600 billion of treasury debt and mortgage-backed securities that by somebody else. And so this is something that's just kind of, I think, underpriced by the market. Another thing that I think the market is kind of underestimating right now, for a long time now when it comes to the stock market, since I'd say since the Trump election and this bull market, this secular bull market was kind of reignited, people have been wondering, what is it that is juicing up stocks in the economy? Is it stocks that are having a positive influence on the economy, or the economy having a positive influence on stocks? And I've kind of been of the opinion that when it comes to increased consumption by the consumer, increased debt load by the consumer, I think that the rally in stocks have to do with that. People see their portfolio, their 401k or whatever they have, go up, 5-10% in a short amount of time, and that's going to cause them to buy more consumer goods because their retirement plan is looking good, so they can, it's just a bit of a confidence piece. But something I think should not be underestimated in this holiday time is the effect that this volatility, this drop in the stock market is going to have on, perhaps the most important month's worth of consumption out of the entire year here in the United States, in much of the Western world. Essentially, people are going to see their portfolios drop by 5%, depending on how heavily they're weighted in stocks, even more, maybe less. But they're going to see them drop. And I think that is even going to factor into just how much extra debt they're willing to take on, how much extra consumption they're willing to undertake in this holiday season. And so, that really paints a bleak picture, of us heading into January. We're starting, we start to receive numbers then based on what consumers here in the United States spent during the holiday season. It's not what analysts projected. And then we're dealing with the Fed tightening. We're dealing with ongoing weakness in the stock market. We're dealing with ongoing weakness in China, the EU. There's not a whole lot of reasons to be, I guess, bullish right now on the economy, bullish on the stock market. And so, those are just a couple other extra things that I think other analysts are just underpricing right now.
All right. Well, Matt, thank you so much for joining us today. Before we let you go, did you want to share with the viewers any last thoughts you had and where our viewers can find your work online?
Yeah, absolutely. You can find me over on Silver Fortune on YouTube. I also am on most podcast platforms. So, iOS platforms, Google, Android, and many, many other ones. So you can find me there as well. Otherwise, as far as precious metals prices, I think they're getting close to turning the corner here for a couple of reasons. I think heading into the holiday season, I wouldn't be surprised if we do see a bit of a rally or at least stabilization in the stock market. Wouldn't be surprised if we saw, the dollar weaken somewhat. And of course, over the last couple of years, January, February, March, those have been some of the strongest years for precious metals moving up. And so certainly, these, do what you will with that information. If that means buying more at these low prices, if that means that you're, I guess, excited to see them rise into 2019. 2019, I think, Fed tightening and just the fact that this economic cycle has been going on for so long is just going to increase stress around the world. You're already seeing this in things like the Yellow Vest protests, what's going on in Italy, what's going on with the Brexit decision, the trade war, China's weakening, the stock market weakness, all of that. A lot of it is a side effect of the fact that we have so much debt and that central banks are kind of tightening the noose around those that are holding all that debt. And so 2019 is shape up to be a very, very interesting year. And I guess I look forward to speaking on my channel as well as with you, Elijah, as we kind of continue to document this descent into what I think is going to be a pretty bad place for the global economy.
All right. Well, Matt, thank you so much for joining us today, and we'll definitely have you on maybe first thing in the new year to look ahead to 2019. And yeah, once again, Matt, thank you so much for your time.
Thanks for having me on, Elijah.